In this video, we're going to look at FLEETCOR technologies, and FLEETCOR provides those fuel cards. You know those cards you use to buy gas? And they're actually a pretty big company. What I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. And I look at the financial ratios of the company and compare them to its competitors. I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $21.9 billion. They're trading at $262.33, so that's one share of stock. And now let's get their free cash flows. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value, which is what I'm doing in this video. And next I'm going to pull the net income, which is the profit and loss on the income statement. And we use 4 years of that for the model. And then we're going to pull the revenue, which are the sales for each year. Now let's look at the numbers. It looks like their revenue has been increasing each year, which is good. Also, their margins are increasing as well. They're becoming more profitable. Net profit margin is net income over revenue. And their free cash flow is also increasing. So everything looks pretty good so far. Let's look at the capital structure of the company so we can figure out what discount rate to apply to the future cash flows. The interest they pay in their debt is $150 million. Let's go to the balance sheet to see how much debt they have. We'll go to the liability section. Current debt of $1.7 billion. That's debt due within 12 months. Long-term debt of $3.3 billion, that's debt due after 12 months. Since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. And it's $1 billion of income before tax and $182 million of taxes. So the effective tax rate is 17%. That means the cost of debt is 2.5%. To get the cost of equity, we need the beta. That's how volatile the stock is. They have a beta of 1.49, so the stock is about 1.5 times as volatile as the market. Let's go back to the balance sheet and get their current assets. We need this to calculate the current ratio later. Current assets are mainly cash, accounts receivables, and inventory. And theirs is $4.6 billion. Let's get their current liabilities. This is how much money the company owes within the next 12 months. That's $4.5 billion. And their equity is assets minus liabilities, and that's $3.7 billion. Let's pull their EBIT, earnings before interest and taxes. That's called operating income on the income statement. And that's $1.2 billion. Let's look at the capital structure. The cost of debt is 2.5%. The weight of debt is 58%. The cost of equity is 14%, and the weight of equity is 42%. So the weighted average cost of capital is 7.3%. That's a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $22 billion. We divide that by 83 million shares. And we get an intrinsic stock price of $267. It's trading at $262, so it's trading at a 2% discount. So it is a buy according to the model, but it's pretty much trading at intrinsic value. Let's see what Simply Wall Street values the company at. Their value is $252, so we're really close. Let's see where the stock has been trading the past few years. So it looks like it was trading in the low 300s a few months back, then the price dropped. So I think the price is where it should be, in the 260s. This company seems to really be growing, and it seems to be the main player in its market. Let's look at the financial ratios. They have 24.5 PE, that's price of stock, 262 over earnings per share, 1072. To get earnings per share, that's net income over shares outstanding. I like to see below 15, so 24.5 is a little high. 8.3 price of sales, that's price of stock, 262 over sales per share, 32. To get sales per share, that's revenue over shares outstanding. So that also is a little high. I like to see below 2.5. Their price to book is 5.9. That's price of stock over book value per share. To get book value, that's just equity divided by shares outstanding. That's also on the higher side. I like to see below 3.5. Current ratio of 1.0. Their current assets are a little lower than current liabilities, but I don't think this should be too much of a problem. ROE at 24%, which is good. I like to see above 20%. That's net income over equity, so they're providing a pretty good value to their equity holders. Interest coverage ratio of 8.2, that's EBIT over interest expense, so they can easily cover their interest expense. The best way to look at ratios is to compare them to similar companies. I've done videos on Accenture, IBM, and Science Applications. They're in the same industry as FLEETCOR. And if FLEETCOR's numbers are in red, they're worse than the average. If they're in green, they're better than the average. So you can see FLEETCOR is worse in every ratio. That's not a positive thing to see. And when I valued the company, I used a conservative model. I didn't use more of an aggressive model, because if I used a more aggressive model, the valuation would have been a lot lower. And everything I read about this company, it seemed like they had a pretty bright future, so I wanted to give them a little more flexibility. So let me know what you think of the video. Thanks for watching.